Welcome back to Marginal Thoughts. Today we're looking at something that really shapes how countries interact economically. Imagine these huge flows of money crossing borders, building factories, creating jobs, but sometimes causing friction too. It's called foreign direct investment, or FDI, and we're going to unpack what that actually means for you. So let's start right at the beginning. What exactly is foreign direct investment?
Right. It sounds complicated, but the basic idea is pretty straightforward. It's essentially a long-term investment. An entity, usually a company from one country, puts money into a business or project in another country. The key phrase you often hear is establishing a lasting interest.
A lasting interest. Okay, what does that mean in practice? Is it just buying some shares in a foreign company?
Good question. No, it's different from that. That's more like portfolio investment, just holding shares for, financial return.
Yeah.
FDI is about having a real say, some influence, or even control. Usually this means the investor gets a significant chunk of ownership, often like 10% or more of the voting power. It's about being actively involved.
Got it. So it's more like putting down roots, getting involved in the management, not just watching stock prices.
Exactly. It's a deeper commitment.
So how do companies actually do this? How does the investment physically happen?
Well, there are a few main ways this takes place. One common one is building something totally new, a factory, an office from the ground up in the foreign country. That's often called greenfield FDI.
Greenfield, like starting on an empty field, makes sense.
Precisely. Or if they already have some operations abroad, they might just expand those existing facilities. Another big way is through mergers or acquisitions. So buying an existing company in that foreign country or merging with one.
Right, like the examples you mentioned earlier, Walmart buying local grocery chains overseas.
Exactly like that. Or forming joint ventures, partnering up with a local company. And even things like reinvesting the profits they make from their foreign operations back into that foreign business. Or providing loans within the company structure, like from the parent company to its foreign subsidiary. That counts too.
Okay, so building new, buying existing, partnering up, or even reinvesting profits are in there. Lots of ways. Those examples really help thinking about Starbucks opening stores everywhere, or Tesla building gigafactories in Germany and China, or Samsung planning chip plants in the US. You see it happening.
Yeah.
All right, so we understand the what and the how, but why? Why do companies make these huge, often expensive moves abroad? What's the motivation?
Yeah, that's the crucial question. And there isn't just one single answer. Companies usually have pretty specific strategic goals they're chasing. We can kind of group these motives into a few main buckets. First, there's what's called resource seeking.
Seeking resources. Okay, so like oil, minerals, that kind of thing.
That's part of it, yes, physical resources.
Yep.
But it's broader than that. It could be seeking cheaper labor.
Yeah.
Think about clothing brands moving production to places like, say, Vietnam or Bangladesh. That's resource seeking for labor. Or it could be about tapping into specific skills or technology available in another country, maybe advanced engineering know-how in Germany, or software expertise in India or the US.
Ah, okay, so resources can mean raw materials, cheap labor, or specialized skills in tech. Got it. What's next?
The second major driver is market seeking. This is pretty intuitive. It's about investing directly in a country or region specifically to sell your goods or services to that market.
Right, being closer to your customers.
Exactly. Many big multinational companies like, say, Boeing or Volkswagen actually sell more outside their home country than inside it. Sometimes they're following their big customers or even their suppliers who've already gone international, like auto part suppliers following Toyota abroad.
Following the leader, in a way?
Sort of, yeah. Or they might need a local presence to really understand and adapt their products, like BMW designing SUVs in the US because that's where the big SUV market was. It can also just be cheaper to produce locally than to make everything at home and ship it halfway across the world. Or sometimes you just have to be there because your main competitors are, like Caterpillar setting up in Japan to compete directly with Komatsu.
Okay, so accessing resources, accessing markets. What else drives FDI?
The third one is efficiency seeking. This is about making the whole company's operations more streamlined and, well, efficient across different countries.
How does investing abroad help with efficiency?
It's often about taking advantage of cost differences. Setting up manufacturing where labor is cheaper, like in parts of Asia or Eastern Europe, or where specific components are less expensive. It can also be about achieving economies of scale, maybe consolidating all production for a certain region into one large, efficient plant, rather than having smaller ones everywhere. It's about optimizing the global production chain.
Makes sense. Lower costs, better scale. Was there a fourth main reason? Something about governments?
Yes, the last main category is favorable government policy seeking. This is where companies invest in a particular country, partly because that country's government is offering incentives to attract them.
Ah, so governments are actively trying to lure companies in.
Oh, absolutely. Many countries offer things like tax breaks, subsidies, low-interest loans, or help with building infrastructure, specifically to encourage foreign companies to set up shop there. The example of Kentucky offering Toyota big incentives to build plants there is a classic case of this.
Okay, so resource seeking, market seeking, efficiency seeking, and taking advantage of government incentives. Those are the main drivers for the companies investing. Now let's flip this around. What about the country that's receiving all this investment? What's in it for them? Is it always a good thing?
That's a really important perspective. For the host country, FDI can bring some really significant benefits. Probably the most obvious one is job creation. When a foreign company builds a new factory or opens a lot of stores, they hire local people. That's usually very visible.
Right, jobs are always a big plus, like that Foxconn example in India, potentially creating thousands of jobs.
Exactly. And it's not just the number of jobs, but also potentially the quality. This leads to human resource development. Foreign firms often bring their own training programs, sometimes introducing new skills, management techniques, or higher standards of work that can upgrade the local workforce's capabilities.
So people learn new things they could maybe use elsewhere later on.
Potentially, yes. That knowledge transfer is key. Which brings us to access to technology and expertise. Host countries can gain access to new technologies, more efficient ways of managing businesses, and operational know-how that they might not have developed on their own. This can spill over and make local industries more competitive too.
And I guess these companies aren't just selling things locally, are they?
Often, no. That's another benefit. An increase in exports. Many foreign-owned plants produce goods specifically for export to other countries, which boosts the host country's overall export numbers and brings in foreign currency. Think about that BMW plant in the U.S. exporting SUVs globally.
Interesting. What else?
FDI can also help create a more competitive market domestically. If you have sleepy local monopolies, a dynamic foreign competitor entering the market can shake things up, forcing local firms to innovate, improve quality, or lower prices. That's generally good for consumers.
Yeah, competition usually helps the customer.
And finally, it can just generally stimulate economic development. FDI brings in capital from abroad. The construction phase uses local labor and materials. Employees spend their wages locally. The company pays taxes. All of this injects money and activity into the local economy, potentially helping fund public services or infrastructure.
And this must be especially important for developing countries, right? Countries that might find it harder to raise capital themselves.
Absolutely.
Okay.
For many developing economies, FDI is a crucial source of external capital, technology, and access to global markets that they might otherwise struggle to obtain.
Okay, so lots of potential upsides. Jobs, skills, tech, exports, competition, general economic boost. It sounds pretty great. But there's always a but, isn't there? Are there downsides or risks for the host country?
Yes, absolutely. FDI isn't a magic bullet, and there are definitely potential drawbacks that countries need to watch out for. One major concern is the potential displacement of local businesses. Large multinational corporations often have huge advantages in terms of capital, technology, and branding. They can sometimes overwhelm smaller, local competitors, potentially driving them out of business.
Ah, the Walmart effect, as some people call it.
That's the kind of criticism you sometimes hear, yes.
Sure.
They might offer wages local firms can't match or use pricing strategies that undercut local players.
That could really hurt local entrepreneurs.
It can. Another big issue is profit repatriation. While the foreign company creates economic activity locally, a significant portion of the profits generated might be sent back to the company's home country rather than being reinvested in the host country.
So the money flows out again.
Exactly. It's a potential leakage of capital from the host economy. Then there's the potential for political corruption or undue influence. In some situations, powerful foreign investors might try to influence government policies or officials in ways that benefit them, possibly at the expense of the broader public interest.
That sounds pretty serious.
It can be. Environmental concerns also come up. Some critics argue that to attract FDI, especially in developing countries, governments might sometimes relax environmental standards or enforcement.
Leading to more pollution or resource depletion.
That's the concern, yes. The environmental impact can be negative if regulations aren't strong or aren't enforced properly. There can also be worries about cultural erosion. When large foreign firms bring their products, brands, and business practices, it can sometimes clash with or overshadow local culture and traditions.
A sort of homogenization.
That's one way to put it. And finally, it's worth remembering the benefits aren't always guaranteed or spread widely. Sometimes the investment might be very focused, say, just on extracting raw materials with limited linkages to the rest of the local economy. The benefits might not really diffuse very far.
Okay, so it's definitely a mixed bag. Real benefits, but also real potential costs. Local businesses squeezed, profits leaving, political influence, environmental damage, cultural impacts. Given this complex balance, how do different governments actually view and manage FDI? Do they all welcome it with open arms, or are some more cautious?
Yeah, governments have taken very different stances over time, and there's still quite a spectrum of approaches. Historically, you can see a few main ideological viewpoints. At one extreme, there was what's sometimes called the radical view. This view, kind of rooted in older Marxist or dependency theories, basically saw multinational corporations as tools of imperialist domination. It viewed FDI as exploitative, benefiting the rich home country at the expense of the poor host country.
So very hostile to FDI.
Extremely hostile. It saw international investment as a zero-sum game, like old-school mercantilism. But this radical stance has largely faded from the mainstream globally, especially since the 80s and 90s.
Okay, so that's one extreme. What's the opposite?
The opposite is the free market view. This perspective fully embraces FDI. It argues, based on classical economics like Adam Smith and David Ricardo, that international production should just happen wherever it's most efficient. Capital should flow freely across borders without government restrictions.
Let the market decide everything.
Essentially, yes. It sees FDI as maximizing global economic well-being through specialization and comparative advantage. Many developed economies lean towards this view, at least in principle.
But you said most countries aren't at these extremes.
Correct. The most common approach today, the one adopted by the vast majority of countries, including big ones like the US, China, and India, is somewhere in the middle. It's often called pragmatic nationalism.
Pragmatic nationalism. Okay, what does that look like?
It means countries evaluate FDI not based on a strict ideology, but on a practical, case-by-case assessment of its likely costs and benefits for their own nation. They'll generally allow FDI if they think the benefits jobs, technology transfer, exports, economic growth are likely to outweigh the potential costs like hurting local firms, capital outflow, or loss of control.
So they try to pick and choose or set conditions.
Exactly. They might encourage FDI in certain sectors, but restrict it in others deemed strategically important. They might require foreign firms to partner with local companies or meet certain export targets or transfer technology. Japan, for example, historically took a very pragmatic, often quite restrictive approach, letting in firms with needed tech, but often only through joint ventures, while keeping others out to protect domestic industries.
So it's about managing FDI to maximize the national advantage.
That's the core idea of pragmatic nationalism, yes.
Just to give us a sense of scale here.
Yeah.
How much money are we actually talking about globally with FDI? Is it a huge amount?
Oh, it's enormous. We're talking about trillions of dollars flowing around the world. In a typical recent year, like 2023, the global flow was somewhere around 1.3 trillion US dollars, though it does fluctuate quite a bit with the global economy. It dipped during the pandemic, for instance, but has generally been very significant.
That went $0.3 trillion in a year. Wow. And where does most of it go?
Well, consistently over the last few decades, the United States and China have been the two largest recipients of inward FDI. They attract a very large share of that global total.
Okay. And how is this even measured? It seems complicated with reinvested earnings and loans and everything.
It is complex. Briefly, they measure it by looking at the total value of the equity stake the foreign investor takes, plus any earnings the foreign subsidiary keeps and reinvests locally, plus the net amount of loans moving between the parent company and its foreign operation. And you can measure it as inward flow investment coming into a country or outward flow investment going out from a country.
Right.
Okay, so we've covered a lot of ground here. FDI is this powerful flow of long-term investment across borders, driven by companies seeking resources, markets, efficiency, or favorable policies. It brings potential benefits like jobs, tech, and growth to host countries, but also carries risks like displacing local firms, draining profits, or causing environmental harm, And most countries try to manage it pragmatically, weighing those pros and cons.
Exactly. And that balancing act, that pragmatic approach most countries take, really brings us to a fundamental question. Given all these potential upsides and downsides, it makes you wonder, who actually gets to decide which kinds of foreign investment are truly beneficial for a country in the long run? And, maybe more pointedly, how much control or influence should a government really exercise over what foreign companies do once they're operating inside its borders? That's a really interesting point to ponder. Where do you draw the line between welcoming investment and maintaining national control or protecting local interests? Well, this has certainly given us a much clearer picture of foreign direct investment and why it's such a significant and sometimes controversial part of our globalized world. We hope this exploration has been useful for you too. What are your thoughts on FDI? How do you see that balance between the benefits and the potential costs? Let us know your perspective. And if you found this helpful and want to understand more about the economic forces shaping our world, make sure you're following Marginal Thoughts for future discussions. Thanks for tuning in.